Welcome to the Stock Market Palantir. Today we are going to talk about DEFT, DeFi Technologies Inc. It currently stands at a deeply fascinating yet, profoundly confusing juncture. The company operates as this regulated infrastructure layer, trying to bridge traditional finance and the decentralized ecosystem. Today we're analyzing the fallout from their pivotal inflection point in late November 2025, which saw two massive and contradictory things happen almost at the same time. The structural contraction of their high-margin prop trading business, DeFi Alpha, and the regulatory success of their infrastructure assets, especially the QCAD stablecoin. So the central question for anyone looking at the stock is, how do you properly assess a company going through such a rapid structural pivot? Does the establishment of a stable, recurring, regulated infrastructure model, rooted in assets like QCAD and Valor, does that fundamentally outweigh the immediate and, frankly, severe financial shock from the retreat of speculative trading revenues? I'm going to argue that the pivot is strategic, it's necessary, and that the strength of their balance sheet plus these new regulatory moats provides a substantial margin of safety and significant long-term upside that the market is just ignoring.
And I come at it from a different angle. While that infrastructure narrative is certainly exciting, and yeah, I'll concede it has long-term potential, the immediate reality is the failure of the old core business model. The sheer magnitude of the revenue contraction, slashing full-year guidance by nearly 47%, that confirms a permanent structural flaw in what they once called the investment bank of DeFi. So I'm arguing that the bullish infrastructure thesis is it's premature. It's overly reliant on uncertain regulatory outcomes, and it hasn't shown it can generate anywhere near the profits to justify the company's valuation.
I think the market is fundamentally mispricing DEFT because it is only fixated on the past profitability model. DEFT is successfully executing a necessary transition into a regulated financial infrastructure entity. Let's look at the assets. First, the regulatory approval of QCAD, announced November 26, 2025. That's not just a footnote. It positions them for a potential monopoly in compliant Canadian dollar settlement. This is a massive shift, moving revenue from speculative volatility to foundational, fintech fees. Second, you have Valor. That's the stable, growing foundation of the whole enterprise. As of Q3 2025, it reported $989.1 million in assets under management, showing resilience with strong net inflows. And what's crucial is that their model is designed for sustained high-margin revenue.
Valor has this highly lucrative double-dipping model. They collect standard management fees on the ETPs, but they also generate and keep substantial staking income from the underlying assets, which we saw with the $7.4 million in Q3 staking income alone. And finally, the balance sheet. It provides crucial context for the valuation. It is, frankly, formidable. $165.7 million in liquid treasury, so cash and digital assets. When a company with genuine growth prospects is trading at only 2.5 to 3 times its liquid treasury, and management themselves are aggressively buying back stock with the NCIB program, it just signals a deep disconnect between intrinsic value and market price.
That liquidity, though, I would argue that's a necessary buffer precisely because the core, high-margin profit center has structurally failed. Let's not mince words about the financial fallout. The full-year 2025 revenue guidance was slashed drastically, from around $218.6 million down to about $116.6 million. That 47% reduction is not a cyclical dip. It's a clear revelation of a permanent flaw in the arbitrage model. Management themselves explicitly cited the proliferation of digital asset treasury companies and tight spreads. This means the arbitrage opportunities that generated so much revenue in 2024, the so-called easy money era, are structurally closed for good. And if we dive into the Q3 2025 financials, we see the immediate pain this caused. Operating income dropped by a staggering 37.5% from $14.4 million to $9 million, quarter over quarter. That margin compression shows a high operating leverage that was tied to those now shrinking trading volumes, so when volumes dry up, their fixed costs just crush profitability. And let's revisit this idea of zero-loss arbitrage. That claim is now complicated by these complex trades, like the $3.2 million SOL token arbitrage trade they reported. This profit is realized over 3 years and is contingent on the asset price. That introduces significant duration risk and asset price risk that just fundamentally contradicts the whole risk-free narrative. And finally, we cannot ignore the recent capital raise. The $100 million introduced massive dilution, 45.7 million common shares and 34.2 million warrants. This isn't just a slight increase, this is a heavy equity overhang. It will structurally cap near-term price appreciation, regardless of how promising QCAD looks, because the market is going to price in the future exercise of those warrants.
I see why you focus so intensely on the guidance cut, but I would ask you to consider why it happened. I would frame this not as a failure, but as a proactive strategic necessity. They cited a delay in executing DeFi Alpha arbitrage opportunities, and that delay is key. It shows that management is now prioritizing rigorous risk management in a tightening market, consciously choosing to step back rather than chase low-quality or high-risk trades. The pivot is intelligent. Move away from capturing high, volatile, and ultimately unsustainable margins, and move towards stable, recurring, regulated fee structures. That is a sign of long-term thinking, not execution failure.
That's an interesting narrative of intelligent delay, but I just don't buy that it's purely strategic risk management. Describing this severe revenue collapse as merely a structural shift is, quite frankly, corporate spin. The prior reliance on wide spreads and those easy mark-to-market gains defined their 2024 results, 132.1 million CAD from DeFi Alpha alone. And that core profit center has evaporated. The market just closed the door on that business model. And we have to look at the leadership shift as implicit confirmation of this. The fact that co-founder Olivier Roussy-Newton resigned as CEO in November 25 and was immediately succeeded by Johan Wattenstrom, the founder of Valor, that signals a definitive end to the trading-centric focus. The trading desk is now secondary.
I actually agree that Wattenstrom's appointment is incredibly important, but I believe it signals a positive, permanent shift to scaling the regulated business. And that brings us directly to the stability of the infrastructure assets. The goal is to generate real revenue moats, and QCAD provides exactly that. We need to elaborate on how that moat works. Stablecoins facilitate billions in daily transaction settlement. By being the first fully compliant CAD stablecoin approved by Canadian regulators, they gain a massive first-mover advantage. This isn't just about holding assets, it's about network effects. They generate predictable, recurring revenue in 2 ways. First, minting and redemption fees, and second, the yield earned on the collateral reserves. This transforms them into a foundational service provider.
That's a compelling argument for the potential of QCAD's revenue. But you are trading one type of risk for another. Have you fully considered the inherent regulatory risk that underpins that entire thesis? QCAD's moat depends entirely on the continued approval from Canadian regulators, the OSC and CSA. If political pressure shifts, or if Canada decides to follow the U.S. lead with stricter banking rules for stablecoins, that entire utility could be threatened overnight. And let's go back to Valor. You praised the $7.4 million in quarterly staking income, but this high-margin stream is highly vulnerable to jurisdictional risk. Valor's ETPs are listed in Europe, and this income is exposed if, say, German or Swiss authorities decide to clamp down on staking for retail products. So while they are trying to escape market volatility, they are simultaneously embracing the severe and less predictable volatility of global regulatory policy.
I'll concede that regulatory risk is a permanent fixture here. But I'd argue that achieving the first compliant status dramatically reduces the operational risk. They have built the moat. Now they just have to defend it. And we have to look at what sophisticated money is actually doing. There's a clear divergence in the data. The stock price suffered a brutal drawdown, over 70% from its high, but institutional ownership has concurrently increased. We see increased positions from major funds like Weiss, Citadel, and Millennium. This institutional accumulation is a classic signal of value investors absorbing the panic selling from retail. They're buying regulatory clarity and balance sheet strength at a distressed valuation. And furthermore, the technical reversal off that key 91-cent low, which happened right after the QCAD news, confirms strong professional accumulation volume. That suggests institutions view the QCAD news as a material de-risking event.
I'm not convinced by the accumulation argument because institutional activity should be interpreted skeptically when a company is in crisis. While ownership is up, that rise can reflect quant strategies or index funds that are required to hold it, not necessarily fundamental conviction. A far more telling metric is the benchmark research report. They kept a buy rating, but simultaneously slashed their price target from $8 down to $3. That is a drastic 62% cut, explicitly acknowledging that the prior high-growth, high-margin model is dead. And let's address the microstructure data you mentioned, the high off-exchange or dark pool trading, which is often between 36 and 54% of daily volume. While this does indicate institutional involvement, it's also recursively ironic, isn't it? They are actively building crypto dark pools through their Stillman Digital unit, while their own stock is heavily traded in equity dark pools. High dark pool volume, especially during bad news, often suggests careful institutional hedging, not necessarily a purely bullish conviction.
I appreciate the nuance there, but the fact that they are buying at these levels, given the $165.7 million in liquid treasury, underscores my valuation argument. And before we summarize, it's vital to quickly clear up the historical corporate noise. Those historical 1 for 10 and 1 for 5 reverse splits you see on the charts are legacy artifacts from the former Rodinia lithium and mining era. They have zero operational relevance to the current business. The focus must be on the current capital activity, specifically management's own buybacks, which signals their conviction that a regulated infrastructure play shouldn't be valued at 2.5 times cash. If we look at typical multiples for regulated fintech infrastructure, which is what they are becoming, they command high multiples. Trading houses are valued cheaply. The market is valuing them like a trading house, but the balance sheet and regulatory wins say they should be valued as infrastructure.
While I concede those legacy splits are irrelevant, the core valuation concern remains the critical lack of clear, predictable earnings given the volatility, the contraction, and the huge dilution we talked about. The company's story is pivoting too quickly. The key metric for 2026 cannot be a speculative bet on something like Solana's price, which, let's admit, is driving a lot of the retail sentiment. The key metric must be quantifiable infrastructure growth. We need to see the minted supply of QCAD growing quarter over quarter and translating into material fee revenue. Until that infrastructure revenue shows it can reliably replace the lost trading profits, the dual pressure of the $100 million dilution and the warrant overhang will continue to suppress any near-term upside.
To summarize my perspective, despite the temporary and structural setback in trading, DeFi Technologies maintains a strong liquid balance sheet with $165.7 million in treasury. More importantly, it has strategically secured critical regulatory footing with the QCAD approval, which fundamentally shifts its identity. It is no longer a volatile trading house. It is a foundational, regulated infrastructure provider for the Canadian financial system, which warrants cautious but substantial long-term optimism.
And conversely, I'll reiterate that the severity of the 47% guidance revision proves that the easy money in proprietary arbitrage is permanently gone. The infrastructure pivot is genuinely promising, but it remains pure future potential, subject to intense and unpredictable global regulatory risk. And it has simply not yet replaced the profitability that has been lost. Investors must closely monitor QCAD adoption and, critically, the sustainability of the Valor staking income before declaring this structural pivot a success.
The story of DEFT is truly a sophisticated case study of a financial firm navigating market maturation and regulatory compliance in the Web3 space, forcing us to weigh tangible liquidity against promising but still developing regulated growth.
It forces investors to decide whether potential infrastructure utility is worth the current price, given the recent substantial collapse of its historical profitability.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.